Happy Tuesday morning, Market Chameleons, and my favorite chameleon, Dimitri Pargamonic. Welcome, D. How you doing?
Good morning, Will. How are you?
Good. I got the disclaimer up, so why don't we start right with that?
Yeah, you know what? Let me just set something up for the show. I forgot to do. And
All right,
then,
well, I'll read the disclaimer.
yeah,
How's that?
Yeah.
Yep.
Can you do that?
Just everyone who's joining us, remember, Market Chameleon, Dimitri, myself, no one involved is a registered investment advisor or broker dealer. We do not make recommendations. This is for educational purposes only. If you need advice, please consult a registered broker dealer. Anything else you want to add, D?
No, that's good.
Perfect.
Yeah, I'm
All right.
just getting some stuff ready that I wanted to discuss.
Also, I dropped in the chat, everyone, the link to the Zoom meeting. You can ask your questions live on the Zoom meeting. That just entails raising your hand or sending me a little note once you get over to the Zoom that you want to have a question and want to ask it live. You don't have to show your face on video. Just come on in and communicate with us your question. That's always helpful, and I think gives the entire community a good look at the product and what's going on. With that, D, you ready to roll?
Yep. Thanks, Will. Let me share my screen. And today, just to remind, we are doing an interactive broker webinar at what time will that be, Will?
That's at 2 o'clock.
2 o'clock. So it's going to be on iron condors. We're going to do some examples of screening for iron condors, discussing them, showing them on the payout diagram. So that will be at 2 o'clock with interactive brokers, and that won't be on YouTube. So if you want to watch it, we emailed out invitations. You'll have to register and then watch it through interactive brokers.
Yep, that webinar exactly is controlled by IBKR. I will put the link, drop it into the chat a couple times so everyone can register who wants to come to that. And if you can't make it by registering, they'll send you a link so you can watch it at your convenience as well. So it should be a good show at 2 today. Thanks, Steve.
Yep. Yeah, thanks, Will. So I think today what I'm going to do is we're going to talk about earnings a little bit because we're coming up on the earnings season. I'm going to give an example of a calendar spread or a time spread because I do get a lot of requests for that to do time spreads. And even though we have some tools that could help you, we don't have screeners yet. I'm working on that, but at least I could show you tools that you can use right now to help out with that. See what how a time spread lines up. So we're going to do an example of that. Also, I want to talk about, I got an email, questions about theoretical values and statistical, analysis and data on the website. And I wanted to clear some stuff up, just because, sometimes I hear similar questions. Maybe there's like some confusion. So I'm going to try to clear it up, maybe show an analogy about theoretical values and what do win rates mean. And like sometimes I talk about it and I think people get it and then forget again. So we'll just quickly discuss that as well. So before we get started on that, let's take a look at the stocks that are moving in a pre-market hours. And then I'm going to jump onto those two topics. We'll quickly talk about, using theoretical values and those types of tools to help in your decision making. And then we'll do a calendar spread setup. Sound good, Will?
Perfect.
All right. So this is the pre-market report. These are stocks that are trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to come down here real quick and see that there's 66 stocks on our percentage gainers list, 32 on the percentage decliners. So from that perspective, it looks like a stronger bullish bias at the open. Let's take a look at I'll do the S&P 500 stocks today. So I'm going to use this filter in ETF. I have a drop down here. And when I select one of these ETFs, some of them are broad based, like SPY, found the S&P 500, Dow Jones, NASDAQ. Some of them are a particular sector. So you could go through these and select them. I'm going to do SPY. And what this will do is just filter out components that are part of the S&P 500 SPY ETF. And here we see that 6 made the percentage gainers list, 3 on the decliners. So really a mixed bag. These are not big, list. The lists are not huge, but nevertheless, we could see, a little bit more leaning towards the bullish side right now. If there are no questions here, just to save time, I'm going to start jumping to, quickly. I wanted to quickly kind of discuss the theoretical value tools and then go to the calendar, earnings calendar spread.
Perfect.
Okay. So, and these are the questions when you guys are on the website, we have a lot of tools and a lot of them reference, historical data, statistics on historical outcomes during certain situations. And when we're looking at that here, I'll show you in the dashboard, we'll have like, here's a market price, here's a theoretical value, here's theoretical edge, historical win rate. And I think a lot of people start getting it over time because the more you use it, the more experience you get, the more you know when to use the tools and how to use the tools. And that will come from experience. That'll come from, seeing different situations and knowing when is the appropriate time to use a certain tool and how to use it and how to assess the surrounding information to make a good decision. All right. And that's the key. It's important to know, you have all these, you have all these different tools, but you can't, a tool is not meant to just take like isolated and not consider all the other surrounding circumstances. And it's not meant to be like, here's, just follow this, right? It's supposed to help you, take to consume the information and make an assessment. And I'll give you an example of what I mean. And I kind of started right before the show. I started like making a picture, a drawing. And this is because I just got this question this morning about theoretical value. And somebody's like, well, does this mean that if I do it at this price and here's a theoretical value that it's going to revert to that price before expiration? That's not what it means. Okay. That's what it's not that. And I had that question before. No, that is not what it means. So then people get discouraged. Like, well, then what is it for? Then I can't use it. It's knowing how to use the tools and when, that's the important key. So I'm going to give you like a real quick example, and I'm doing a football example. So this is, let's just say football, right now we're in football season, and I was watching the Eagles game. They won, so I'm excited about that. So that's why I just kind of picked football. And coaches, sometimes they have to make a decision, right? A coach makes a decision, and a lot of times they make decisions based on a statistical probability, right? So you have to make sometimes you're faced with, what do I do? What do I do now, right? And you kind of do that on every play, right? Every play, they don't just randomly start running around and hoping for the best. There's a plan, right? There's like, well, let's run this play because we think this play has a good chance to achieve this objective. All right. And that's why they're coaches. That's why they practice. That's why, that's why, a team huddles up and comes up with this plan. So let's just say, here's a situation, right? Let's say it's 4th down and you have 1 yard to go. All right. So for people who don't know football, it's like, I guess I won't be able to explain the entire football. So hopefully a lot of you already know what that means. Okay. So fourth down, there's 1 yard to go. You're 40 yards away from a field goal, right? So you have to make a decision. Do I kick the field goal, right, and get 3 points? Or do I try to go for it and run 1 yard, which 1 yard is usually not a far distance to go. And you're going to face this decision. You're like, well, what do I do? Right. So right now I'm looking at no information, no data. So I have no idea, what I should be doing. So then I kind of start looking at, okay, my kicker, right, from 40 yards out. So from a distance of 40 yards out, what is the probability he's going to kick it? Well, I don't know for sure, right? Until he kicks it, I don't know. But I could look at historical data and say, well, what is his percentage? And let's just say from 40 yards out, the kicker is 90%. He made historically 90% of the times he tried, it was successful. All right, so that's one piece of information now that I'm consuming, right? Then I'm going to say, okay, well, we have 1 yard to go. I could start looking at statistics, like let's say on 4th and 1, what are the percentage of times we convert, right? So I could take a look at this 4th and 1. Sorry, what is my conversion? Basically, if we get this 1 yard, and let's say that is lower, let's say 55%. Right. So now I got this data in front of me to help guide me in my decision. Right. That's what it is. It's to kind of help guide you. What do you think? We don't know what the outcome is. We don't know. There's no reversion. We just have, the data in front of us to help us kind of guide which decision should I make here. But on top of that, let's say I have more data, right? I have more information surrounding data that is not reflected in these numbers, okay? And what does that mean? Well, I have a kicker, 90%. So that looks to me like, what, maybe I should go with that, because there's a better chance that I score, with the kicker than, I got like a 55% chance of 4th and 1. So now that would be kind of like what those trade cards theoretical values are. Let's say I take in more information. Let's just say, hey, you know what? There's a lot of wind, right? A lot of wind blowing, because remember, we're traders, right? We're traders. We need to start doing research and, let's do this and start assessing the information and really calculating what we think are probably. Let's say there's a lot of wind blowing this way against me, right? Not to my back, but against me. Well, all right, now I got to take that information and say, okay, well, that 90%, that's going to offset. That's going to, potentially take that 90% and take it down by a lot, depending how much the wind blows, right? Or let's just say the sun is beaming in your eyes, right? So what is that? That's an external factor. Like that would be like you looking at the market risk and say, okay, what is the market risk right now, right? Because each stock has market risk. Let's say you're bullish on a stock, but if this entire stock market is falling to pieces, or we have a COVID situation, or right now people have inflation fears and certain stocks are getting hit, certain stocks are going up. So these are market external risks that could weigh in on that decision, right? So you have to start looking at that as well, because there's no way for, you have one piece of data, he's 90% success, right? But that's one piece of data. What about the other ones, right? So there's no one stat that's going to encapsulate everything. And that's your job as a trader, right? To start assessing that. There needs to be human intervention, and you're looking at all the data to make that decision. So that would be like market risks, right? External factors. But what about it? What else can be? Let's say sun is good, no wind, nothing. But let's say your kicker, right? Your kicker, all of a sudden, hey, you know what? He injured his foot. He injured his foot during practice. Well, that's not good. Or that, hey, he was sick. He had, he was shown some symptoms of whatever, flu or whatever. He says he's okay, but I don't like he's like a little bit wobbly this morning or a little bit out of it. That could weigh in your decision. So that's what we would call firm specific risk, right? Firm specific risk that didn't exist in the historical data. So what is a firm specific risk? Like right now, Facebook, right? there's a whistleblower. Now there's uncertainty. We don't know, we don't know what the outcomes will be there. It could weigh in on the stock. We don't know how many negative headlines there are going to be. So all of a sudden, there's a new piece of data, new element that's specific to Facebook. It could be specific also to other social media, but it could affect them. But now you got this firm specific risk that did not historically exist. This is the first time we see a whistleblower, come out and testify in front of Congress. So then you got to take that and also weigh it into your decision. And this is your job as a trader. If you're not willing to do that, you're not trading. Then don't call yourself a trader. Just, then just, I don't know what you're doing. But that's your job as a trader, right? And the tools are there to help you, right, to make those decisions. But you need to start looking at the surrounding data, and this will come with experience, right? Nobody can just sit there and tell you what to do. It's going to be experience that will show you how to use the tools, when to use them, because obviously if you're first down and 10 to go, you don't need the stat. How if you're on a 40-yard line and it's 1st and 10, then your kicker kicking 90% right now is not relevant, right? Right now, you don't need to apply that to your decision because you still have 3 more downs to get another first down to score a touchdown. So that's kind of, I wanted to explain it because some people maybe are confused. Does this mean it reverts and I have to do it? No, it's help guide you in your decision-making process, but you have to take all other circumstances, the surrounding circumstances into account. All right. Hopefully if there are no questions on it, I'm going to move on, but I kind of just wanted to show an example of what I mean.
Yeah, no, they loved your analogy, D.
Okay. And again, you might, 90%, you might skip it and go to the 55% because you might think, what are these other risks? Maybe the wind's blowing too fast, and maybe the firm specific, maybe, he's the kicker injured himself, or, the placement holders knew, whatever it is, you might say, I'm still going to go with the 55% because this one, circumstances have changed. So that's kind of my point, So I'm going to close this real quick. And then having said that, let's take a look at maybe a trade setup, and then we're going to use historical data to kind of help us guide us. Okay. So that's what I was setting up right now. I have some internal alerts, so maybe I'll just kind of reference them. So let's say Starbucks, right? So Starbucks is going to report earnings. So here's Starbucks. It's going to report earning, right now expected October 28th after the market closed. So we got some time before it reports earnings. So let's take a look at the options chain here. And we see here that here's October 29th. So this is the expiration that's going to cover earnings, so as long as they report October 28th, they indicated, October 29th will cover earnings. October 22nd, October 15th, they'll expire before they announce earnings. So these are what we'll say non-earnings expirations. And we could see the difference in the implied vols, right? October 22nd, the implied volatility is 19.8. And here, October 29th, the markets are now pricing in an earnings move. So the implied volatility is higher, 25.7. So our question is here, well, what if we wanted to do a time spread, and we agreed that October 29th should be priced higher than October 22nd because there's going to be an event, right? But if I do a time spread between October 29th and October 22nd, is this a good deal, right? Am I getting a good deal? Should I even do it? Should I skip it? Should I do the other side? So that's kind of the question right now we have. So the time spread that I'm going to look at is, well, what if I think that October 29th, right now, this option, I want to I want to own that volatility. I want to own that option ahead of earnings. But to finance this, I know, I'm going to have to, I might sell an option in a prior month, non-earnings. Okay. So is that a good deal? Not a good deal? Should I do it? I don't know. Right. And I don't know the outcome. But what I could do is just kind of take a look at the historical data and say, well, where does it usually get priced? Right. Like what usually, just like, my kicker, I don't know if he's going to kick a field goal or not, but if he's 90%, that's kind of helping me guide my decision making, right? So that's kind of what we'll do. So when we do a time spread, there are two things kind of going on. First, I have to decide, if the relative difference implied volatilities are favorable to me, and which strike should I select. So the strike you select, because we could do an at the money, the 111 strike, we could do an out of the money strike. And that's difficult too, and it's important because it's where do you think the stock, right? So let's say I'm doing October 22nd, October 29th. Where do I think the stock is more likely to be, October 22nd? Because that you want, wherever that price goes to, right, that's your sweet spot, right? The closer it is to the strike, if you're getting long the calendar spread, right, the closer it gets to that strike, the better it is for you. And that's one thing we have to pick. So without first picking the strike, let's just see it at the money, right? So if I buy on October 29th, buy the 275 call, I'm sorry, the 111 call for 275, right? So here, buying the October 29th call, 275, and that's going to cover earnings. And then let's say on October 22nd, then I'm going to sell the 111 call for $1.61. So what I'm saying is I think that the stock is going to really sit here from now to October 22nd. Not much is going to happen. It's going to expire, but the October 29th call will keep more of its value, potentially even high volatilities go up, and that spread is going to be profitable on October 22nd expiration, right? So let's just load that strategy and take a look. So you see here that our sweet spot is right at the 111 strike. What would it cost us right now? So if we bought it for 275, sold the 161, that's $1.14. And we see that the spread is 91 cents, $1.14. So it's kind of wide, midpoint 103. So that gives us, saying that we have a lot of room in between, and potentially, maybe somebody will sell to us for $1 or 95 cents, but again, keep in mind, with this spread, it's a pretty wide spread. You can put in limit orders. The lower the price you get, the better, right? The higher the price you pay, the worse, right? Because then you have to make up for that. So now looking at $1.14, our question is, well, in a similar situation, right? In a similar situation, what happened before? And that's kind of like, what we're doing here, in similar situation, 40 yards out, what happened before with the kicker? Well, he was 90%. That's what we're looking. We don't know if he'll make it until he kicks it, right? And we have to take other circumstances into account. But right now we're at the stage where 40 yards out, should I kick it, right? And then I revert to my statistics and say, well, for 40 yards, it seems far, but my kicker is 90%. Does it make sense so far? So this is kind of where we're at right now. So where are we on this spread? So we need to kind of look at similar situations. So I go here to the IV here and say, okay, this is historically, where the option markets lined up. All right. So if we took a similar situation, said, okay, well, we have an expiration that's has 14 days to go, and it covers earnings, right? This one will cover earnings. And then we had another situation where we had an expiration with 9 days to go, but that expiration did not cover earnings. Okay, so historically, we're looking at for a similar situation. How did the markets line up at those points? So, are we paying over that amount, under that amount? That's kind of what we're trying to see it. And here are stats. On average, if we, and here's the data below, so we're looking at the snapshot. We're taking the implied vols, snapshots, converting it to the prices where it would be right now, theoretically, and where they were historically, I'm sorry. And on average, a similar spread would be using 4 years of data around $1.12, right? So $1.12 on average, we would have to get it below, you would want it to get it below if everything else is equal, right? Remember, we didn't look at market risk or firm risk, just everything else equal, how much is in there. So, potentially we could get under 112, right? Because look, 91 bid, 114, midpoint 103. So potentially we could get a decent deal, right? And the high end is 150, low end 68. So we're kind of like in between there, right now. And this is how the tool and one piece of information starts to help in your decision-making process, right? So where do we get to? We kind of got to like over here, right? That's where we are right now at this stage. And then you could start, looking at more data. Well, what about maybe I don't want to do that at the money. I could look at more historical data, right? In earnings, what did the stock tend to do? We still got like 2 weeks. Well, here's Starbucks. Here's what the stock tended to do moving into earnings. So usually it gained a little bit on average. On average, it ran up more often than it went down, sometimes 50-50. So maybe I'll use that and say, what, I'm gonna move up a strike. Maybe nothing's going on in Starbucks, we're in a bull market, whatever, making just off this data. Maybe I come over here, I'll say, instead of the 111 strike, maybe I move up to the 112 strike. So I sell the 112, right? Buy the 112. So now I just shifted my curve up, right? Now there's my sweet spot. There, midpoint $1.71. What is the IV Theo? 173. So, I might not want to pay that off, or 189, but somewhere in between potentially. So now I took another piece of data, right, and adjusted it. Now I took in not only the difference in the premiums and implied volatility, but I added another layer and said, hey, you know what? Maybe there's a more likelihood chance that it moves up from here between now and the next expiration. So I'm going to move up a strike, right? Now, I don't know what's going on in Starbucks. Maybe there's other things. So I got to go in there and read, because I see, hey, right now it's kind of in a bearish technicals. Are there other external factors that are affecting it? Is there something going on, particular in coffee? Is inflation affecting them? Is there supply chain? All this stuff I still have to assess as a trader. You have to do it. If you're not willing to do it, then you're not trading. Okay. So really quickly, I wanted to kind of just start pointing out, how you're starting to use tools to help in your decision-making process.
Well, Dee, those were some great analogies. The Chameleon community is pumped that you just went through that. That was awesome.
Okay. Well, guys, thank you for joining. Stay safe out there. Have a good trading day. Many of you hope to see you guys on the Interactive Brokers webinar at 2 o'clock. If not, hope to see you guys tomorrow.
That webinar, the link to register, you must register. It is held by IBKR and they control the webinar. So that link is in the chat. I will go back and copy it and put it at the end of the chat as well. Thanks for joining, everyone. Dima, great job as always. Have a great trading day. Hopefully we'll see most of you at 2 p.m. today on IBKR.